Hello everyone, I'm Shivang Mehta. Today we are going to study and analyze the new fund offered by UTI, known as UTI S&P BSE Low Volatility Index Fund. So basically, it is a passive fund launched by UTI, one of the most trusted mutual fund company in our country. So today we are going to do an in-depth analysis about this new fund offer of the company. Moving to the next slide. So what is UTI S&P BSE Low Volatility Index Fund? UTI S&P BSE Low Volatility Index Fund is based on S&P BSE Low Volatility Index Fund, which is designed to track the performance of 30 companies from the universe of S&P BSE Large Midcap. These companies are lower volatility stocks as measured by their standard deviation of the last 252 trading days. So basically, S&P is a rating agency, Standard and Poor, which is an index of 30 companies which belongs to large cap and mid cap category and are comparatively lesser volatile than other companies in the stock stock market. So these 30 companies are selected by a moving average of 252 days using standard deviation. So coming to the basic details of NFO, so it is an open-ended scheme replicating tracking S&P BSE Low Volatility Index TRI. So open-ended scheme means you can enter in scheme in any time and you can exit the scheme anytime. So there is no lock-in period for the schemes. Benchmark, as we already know, S&P BSE Low Volatility TRI. Fund manager is Dr. Sharwan Kumar Goyal. Plans and options. So regular plan and direct plan, both plan offers growth option only. So basically there are two trends. Regular plan is through an agent and direct plan you can direct approach fund house through its website and you can invest in the fund. Minimum application amount is ₹5,000 and units will be issued in the multiples of ₹1. Market cap exposure. So the every penny you spend, 0.63 paisa will be spent in large cap, 0.28 in mid cap, and 0.9 in small cap. So this is the most easiest way to understand how our how our fund is diversified in different categories according to the market capitalization. Why UTI S&P BSE Low Volatility Index Fund? Why should we invest in this? To diversified portfolio of stable companies within large cap and mid cap segment. The fund shall follow a passive strategy by investing into the constituents of S&P BSE Low Volatility Index, where the index construction is based on low volatility within the universe of S&P BSE Large Cap and Mid Cap Index. So basically, company or UTI mutual fund says that the portfolio is diversified, and this diversified portfolio is built on the basis of low volatility fundamental, focused and disciplined. A diversified portfolio of stable businesses that are expected to deliver long-term growth with lower volatility, as we have seen earlier. Long-term wealth creation. So major aim of this new NFO is long-term wealth creation. So by investing only into companies that generate economic value, the fund will endeavor to generate wealth for investors in the medium to long run. Scheme objective. The objective of the scheme is to provide returns that before expenses closely correspond to the total returns of the securities or represented by the underlying index, subject to tracking error. However, there is no guarantee or assurance that the investment objective of the scheme will be achieved. So this is also cleared by the fund house. Why should you invest? Who should invest in UTI S&P BSE Low Volatility Index Fund? So investor looking to take exposure in relatively stable companies, investors who has low volatility appetite are suitable to invest in this fund. Investor looking for passive fund which bring disciplined approach to the portfolio construction while adhering to the defined selection process. So investors who has very high risk appetite or very low risk appetite, apologies, So, and don't want to give their money in the hands of any other people, can invest in this passive fund, which is automatically managed through index replication. So now looking at the list of companies that are there in the BSE low volatility index of S&P. So top 10 companies are Gillette, Maruti, Pidilite, Infosys, Nestle, Dabur, Britannia, ITC, SBI Life Insurance. Highest weightage is with Gillette, Maruti Suzuki, Pidilite, Infosys, Nestle. These are top 5 companies with the highest weightages. As you can see, the portfolio is completely diversified into different sectors: automobile, chemicals, consumer goods, financial services, pharma, IT. So the so basically the risk of risk of losing money is reduced through this diversification. And as we can make out from the legacy of these companies that the volatility of stocks will be lesser compared to the other companies, since like company like Gillette, Maruti Suzuki, Infosys are ruling market now over 20 years and showing 10 to 12% profit and revenue growth quarter to quarter in every financial year. Pros of investing in the NFO: so invest in a diversified portfolio that are likely to deliver long-term growth with minimal volatility. So minimal volatility will be there with long-term growth. So it invests only in companies that generate economic value. So true economic value will be generated by when you invest in this portfolio, since the money is diverted towards companies which also generate economic value for the society and economy of the country. Suitable for ultra conservative investors looking to add passive investment to their core equity portfolio. So this basically NFO is suitable for the people who has very less risk appetite and still want to take advantage of the you know growth of growth story of economy of India. Cons of investing: as this fund invests in equities, it is not suitable for short term. So those are who are looking for short term gains, this NFO is not at all suitable for them, and they might incur losses as well in the period less than 1 year. As an index fund, this may underperform its index due to certain factors. So basically, this says that in a very short term, this index may underperform the Nifty 50 index, and considering certain factors, this fund will not be able to deliver market beating returns. So as we can make out that this is low volatile, these all are low volatile companies. So market beating returns of over 20-25% won't be possible with these companies, but we can consider at least double-digit returns over a long period of time, year on year. So should you actually invest in this NFO? So let us analyze which kind of investor are suitable for this NFO. Suitable for ultra conservative investors, as we have already discussed. There are similar index funds that have lower expense ratio and lower tracking error. So since with NFO comes the risk of newness, but as we know that there are many index funds that are already existing which has lower expense ratio. The expense ratio is basically the cost we have to pay to the fund manager, and low tracking error. So we don't know about the tracking error of this new NFO, and we have already proven portfolios which which already have low tracking error. So we have to look in future how this NFO is managed. Actively managed funds have potential to deliver higher returns than this fund, of course. So in future, as you can make out, as financial literacy is increasing, actively managed funds can give multi-bagger returns, but with that comes the risk of losing money in short term as well, and you should have high risk appetite to invest in actively managed funds. Investors expecting dynamic fund management and looking for investments that can beat the market should avoid the fund. So people who are expecting any fund management in this NFO should avoid investing in this, because this is a passive investment. Directly whatever S&P Standard and Poor rating index shows in its weightage of stocks that will be replicated by the fund house. So investors should consult their financial advisors. So every investor has their unique financial situation. So they should, consult their financial planners about their risk appetite and what is their short-term and long-term financial targets. Thank you.